Pleasant good afternoon to all members. Welcome to this evening's webinar entitled Pathways to Prosperity, Your Guide to Making Smart Insurance Choices. My name is Narissa Mohammed, and I'm the chair of SECU's Education Committee, and it is my pleasure to be your moderator for this evening's session. Do you remember that old saying, don't put all your eggs in one basket? But today's webinar is focused on educating our members on various ways to grow your savings and plan for the future using various investment vehicles. Whether you're exploring insurance for the first time or looking to better understand your existing coverage, this session is designed to provide clear guidance and help you make more confident, informed decisions. Before I introduce our presenter, please allow me to share our house rules. Firstly, please note that all mics will be muted throughout the presentation. At the end of the presentation, you will have a Q&A session whereby you can ask your questions. During the Q&A segment, if you have a question, please click the raise your hand button on your mic, and your mic will be unmuted for you to speak. Throughout the presentation, if you have a question, you can also type it in the chat, and we will address it at the end of the segment. This seminar will also be recorded, and the recording will be uploaded in the library section of SECU's website, along with the presentation. This evening, it is my pleasure to welcome our presenter, Mr. Kailash Dinarain, Financial Advisor at Sagicor Life, Trinidad and Tobago Limited. With over 23 years of experience across diverse industries within the service sector, Kailash is a passionate and dedicated professional recognized for his commitment to excellence, customer care, and financial empowerment. Kailash has focused on the financial services sector, helping families safeguard their future through tailored insurance-based solutions. As a financial advisor at Sagicor Life, he is driven by a mission to enhance financial protection through education and engagement, ensuring clients achieve peace of mind and long-term stability in uncertain times. Kailash holds a Master's of Business Administration from Heriot-Watt University, a BSc in Management from the London School of Economics and Political Science, and professional credentials from the Chartered Institute of Marketing and the University of Greenwich. Kailash, welcome, and we hand things over to you.
Hi, good evening, everyone, and thank you, Narissa, for that lovely introduction. I'm not sure if that is describing me or something I should aspire to, but I appreciate it. I would want to thank Narissa and Mrs. Hack, as well as the other members of SECU for inviting me to speak with you all. Usually it tends to be a bit more interactive with me. And during my presentation, I hope any questions or queries or comments you all have, feel free to put it in the chat. And I will try to give as much time at the end in order for us to really have an open discussion. My approach this evening would basically be the same approach that I have with clients on an individual basis, which is really to educate people, create greater awareness of things like financial risk, the options available to them, how to go about financial planning to a large extent, and thus empower people to really make better decisions for themselves and their families. So I'll just pop up my slideshow and we could get started. All right, and that's our nice building. This was the introduction I was going to do, but Narissa did a much better job. All right. Now, one of the things that I always emphasize with financial planning is before anything else, it is really a mental thing in that before any decisions can be made, before understanding where you are financially, you need to recognize where strengths and weaknesses may lie in your approach to financial planning. So my first question or food for thought is, would you rather over-prepare for a potential negative event or under-prepare and count on quick improvisation? Now, it seems maybe a bit vague, but it really does, oops, I'm going forward, right? It really does direct you towards your risk averseness. So people who over-prepare tend to be a bit more risk averse, and they focus a lot on savings. They may focus on insuring themselves to the extent that they may over-insure themselves. The people who are under-prepared and they count on quick improvisation, they tend to be more risk-taking. So you will always hear about people focusing on things like investments. They like to use that term, saving versus investment, and they tend more towards the investment because they believe it's worth the risk, the payout would be greater, and therefore, if anything should go wrong, they have contingencies in place. So when approaching any type of financial planning, it is one of the key questions to ask yourself: how do you view risk, and are you more risk averse or more risk taking? Just remember, it's a continuum, and you don't have to be either or. You could tend more one way or the other, and there's always the opportunity to make adjustments to improve your situation. All right. The other thing to consider is, what are the major trends that you will find? And this is something that I came across that is very realistic in our local market, but it stretches throughout international markets as well in terms of people's financial preparedness for different things. 60% who went through a financial crisis like job loss or divorce are unprepared financially. Some of the other 75%, the last dot you will see, don't have 6 months of living expenses saved. And when you look at these things, they tend to say, well, I have living expenses. I can't do these things. Where am I going to get the money from? I have more immediate concerns. I can't be planning for the long term. And I'm not going to say that they're all not true. What I'm going to say is, a lot of times people are unaware of where they are from a financial standpoint, and therefore they make decisions that may not be the most astute because of that unknown value. And we'll get into things like budgeting and priorities and so on a bit later. Yeah, give me 1 sec. I just wanted to get back to this. Okay. Now, when we talk about financial planning, which is the direction we're going in, and yes, I will focus primarily on the insurance aspect. Financial planning, or planning in general, is bringing the future into the present so that you could do something about it now. And again, this is where the question of saving, protecting income, and so on versus investing comes into play. What type of future are you looking for? How are you going to plan for that future? What are the concrete steps that you can take? Because simply setting a financial goal, whether it be income protection, saving towards a mortgage, saving towards retirement, investing in stocks, shares, bonds, saving through the credit union, having the goal is great, but unless you actually go through the process of a step-by-step plan to get to that goal, you will always run into some challenges because you don't have that guide. And part of these series that Secure is offering, I believe, is to help people create that personal guide for themselves so that they can make better financial decisions. Yeah. Now, for my part, when it comes to insurance, primarily we focus more on the protection side, not just savings. Credit unions are fantastic for the savings, but more so income protection. And why income protection tends to be our focus is because if that income is no longer around, then no other plan, whether it be financial plans, houses, education, vacations, no other plan will have a likelihood of success. So we want to make sure that that which is the foundation for everything is actually protected in case things go a bit wrong. Yeah. And Narissa, you can tell me if I'm going a bit quickly. All right. Okay, so the foundation, if we're looking at income protection, is really and truly why do we work? And we work to earn an income. So this is literally a presentation I show to a lot of individuals who are not aware of insurance and how it's supposed to work and what is the relationship with income protection and so on. So we work to earn an income, and the assumption is the longer we work, the higher that income will grow. So whether it be through bonuses, increases in salary, new jobs, etc. Over time, that income will grow. And we need that income to grow. But there are instances where that income could either no longer be available or it could decrease. And we may have gone through it, or people we know may have gone through it, where it could be due to job loss, it could be due to the loss of a breadwinner, it could be due to some medical issues and so on, that the person is unable to work. So the mistake that a lot of people make is that they tend more towards the green, in that I think the income will always be there. I think the income will always grow. So I don't really have to prepare for anything else. And those are the ones that tend to be more risk-taking. Now, when it is we look at income, we have to consider the different sources of income. The first source, of course, is the one we're most accustomed to, which is you at work. So you go to work, you earn your income, you pay your basic bills, food, shelter, clothing, education. If you're a true Trinidadian, we have to budget for liming in there somewhere, vacations, all of these things. But the premise for you being able to pay any of these is that your work, your income is stable, your income hopefully will increase over time. For us, we always want people to strike a balance in their financial planning. And yes, while you're planning for all the good things to happen, you have to look at if something that were to happen and you were unable to work, where would the money come from? So that is where putting your money at work for you comes into play. And that is the main focus with insurance. And people believe that whether it be life insurance, critical illness, retirement plans, and so on, they think it's really not something they need to be concerned about immediately in the short term. But we never know what can happen in the short term that could negatively impact on your income. The third source of income, if things were to go wrong, would be charity. And nobody really wants to end up in that situation. That's where we talk about people selling barbecue tickets. And now you have things like Fund Me TT, or in the US, you have GoFundMe. And it's, again, inconsistent. You don't know what the outcome is, and you don't know how that can impact on your family. So when we want to avoid charity, and we know that, yes, as much as we want to make sure that we plan for the positive, the green arrow situation where work will always be there, we want to make sure and put your money to work for you in case some of the bad things happen. Now, when we look at financial planning, there are 5 main things that we look at. There are immediate risks of death, disability, or critical illness of an income earner in the household. Then we have to look at longer term things like planning for retirement. People think they have a lot of time. It really isn't that way. And then failure to save and invest. And this is where services offered like by credit unions like Secure and so on come into play, because it broadens your whole financial portfolio. So when we again focus on income, the focus is while you're at work, to put some, not all, some of your money at work for you. So in case any of these risks should befall you now or into the future, there is still enough money to take care of your living expenses, maintain your standard of living, and any such expenses. Yeah. Hopefully I'm not going too fast and you're all okay so far. All right. So one of the things I like to do is have little questions in between. So this is my first food for thought, really and truly. If your current income disappeared tomorrow, It doesn't matter for what reason. It doesn't have to be death. It doesn't have to be a medical issue. It could simply be that you lost your job. How much or how long, how many months could your family comfortably maintain their current lifestyle on your savings? Because remember at the start, the risk-averse people and a lot of people that I speak to tend to say, well, I'll put the money in savings, which is fine. It is an important part of your financial portfolio. But the question is, how long would it last? Now, these are questions that you take your time, you go through your budget, you go through your savings, and you see, okay, how much do I really have in savings? Now, while you're thinking about what the first expense you'd have to cut would be, here's how you do this. You earn an income. Let's take out all the statutory costs, tax, NIS, health surcharge. If you're a member of the credit union, you're taking out all the standard costs. You're left with your disposable income. From that, you take out all your living expenses. We'll get into the budget a little bit later. What you want to do to get the income is look at the savings you have and divide that savings by your total monthly living expenses. And that will tell you how much or how long your savings will last before you really run into financial problems. Now, my question to you all is, have you ever done that before? Whether it be as it pertains to savings or when it comes to your insurance, because it is something that we also recommend for people who currently have life insurance coverage. If you were to die today, tomorrow, if you were to become critically ill today, tomorrow, and you're unable to work, and you have this insurance coverage in place, if you divide that insurance coverage, $1 million sounds like a lot, but if you divide that by your monthly living expenses, how long would that money actually last? And one of the things that we recognize in Trinidad is probably up to 60 or 70% of the people who have insurance are still underinsured for what it's supposed to suit. So I don't know if you all have access to the chat and stuff. If anyone has any idea, what would be the first expense you would have to cut if it is that you were surviving on your savings alone? Anyone? I can't see the chat here. Let me just close this. Anyone say anything in the chat and stuff? All right. Prepare. All right. And there's a pool out there for how long your savings would last. Thanks so much for that, Davil, with the pools and so on. And you all could click on the pools anytime during the session and give your answers. But a lot of times the outcome of doing these kinds of exercises are not usually going to be that positive. So we want to always be cognizant that financial planning, income protection, savings, retirement planning, it's always an ongoing process. Yeah. All right, so we continue. All right, so when do we really need income protection? And it's usually when something goes wrong. So when a breadwinner dies or becomes critically ill. Now, a lot of people mix up critical illness with health, and they both serve a purpose in your financial plan. It's good that a lot of the credit unions offer health plans as well as just savings, as well as their FIPs for a form of life insurance. But critical illness differs from a health plan in terms of its purpose. A critical illness plan is also an income protection plan. So whereas a health plan is a medical reimbursement plan. So with critical illness, your medical expenses don't really matter, all right? It's a lump sum payment that is made based on the diagnosis. Now, when we look at the big three, heart attack, stroke, cancer, that accounts for about 70% of the claims that we settle. Those are critical illnesses that if you're diagnosed with them, chances are you're unable to work, you're still alive, so the life insurance isn't going to kick in, but you still can't work. So what we do is we pay you this lump sum of money, and you can use that for whatever you wish. So you can use it to pay medical expenses, you can use it to pay off loans, mortgages, you can use it for groceries and so on. We don't tell you what to do with the money. It is meant to replace the income that you can no longer work for. And it's the same with disability coverage, in that if you get into an accident or you get critically ill and you're unable to work, that lump sum is supposed to help you with living expenses. Now, the other things, now those are the more immediate risks. The other things to consider are things like longer term goals, medium to long term, retirement planning, if your kids need education funds, well, I mentioned the healthcare and stuff already, and the fact that you need savings and investment. Remember again, if you don't earn any income in as much as you want to save, that money now has to go into your living expenses and your savings will suffer. So sometimes in investing in certain types of products, it helps to not only protect against regular living expenses, like things like life insurance and critical illness could provide funds to help achieve some of the goals you had set out for your family, things like education funds, paying off medicals, and so on. Yeah? All right. So here's another little idea, food for thought. You worked as a chef for your uncle's restaurant for years. So this is how you take care of yourself, your family. All right. Wife, kids, or husband, kids, and so on. And you unexpectedly inherited it upon his death. What would be the first thing you'd ensure and why? Anyone wants to venture, I guess, an idea as to what would be the most important thing to ensure at this point? Not sure if anyone is seeing anything in the chat or any ideas. Remember, the focus is on income protection. So what would you think would be the most important thing to ensure at this point? And if you have any ideas.
Hi, Kailash.
Hi?
Yeah, this is Paula. I would say maybe the restaurant itself, the building, in terms
Okay.
of insurance.
Okay. Why the building?
Because if, for example, there's a fire
Mhm.
or break-in,
Mhm.
at least the insurance would be able to cover.
Absolutely.
Mhm.
But here's the thing. It will cover replacing the building, which is very important if there's a fire
Yeah,
and so on. And that does impact on the ability to earn that income. But would that be the first thing you would want to ensure, given the scenario?
maybe the kitchen equipment then.
So we're still dealing with things. Now, let me ask you,
Okay.
which is easier to replace, the things or the people? A restaurant's
Mhm.
reputation is based, yes, on the ambience, yes, on the
Yeah,
physical, but what determines the
the
benefit
service
to the
and
clients? The
right, the
service
people. Yeah, the service from the people.
and the food.
Yes,
So if the chef were to die, then what happens?
I
The
guess
building is
people.
still good.
Yeah.
The customer service from the wait staff is still fantastic. Is the
Yeah,
food
but
going to
the
be the same
food,
quality?
well, may not.
Yeah, exactly.
Yeah, may
So
not. Yeah.
in that situation, and this is where the income comes in, the income
Mm-hmm.
protection comes into play, because everything else can be replaced to a large extent and take us back to what we were before if the same chef was there. You
Yeah,
ever
yeah.
realize that when any restaurant is looking to make a change in terms of who they are, in terms of how people view them, the first thing they do is change the menu. And more than
Yes,
anything else, when they're changing the menu, it means they change the chef.
that
Because
is true. Mm-hmm.
if you know any people who are chefs, they don't like people telling them what to do and what not to do when it comes to food. And this is the same premise for anything, even in your household, right? Especially if it's a two-income household. You could insure the car, that's the law, insure the house, and have all these things in place. But if something were to happen to the main income earner or one of the main income earners, then nothing else can fall into place.
Yeah.
Yeah.
Understood.
All right. Great.
Thank you for that. See you later.
Okay.
Okay.
All right. So we move on to where did I go? Right. So, and this is why I keep focusing on when I do these things, it's not so much about the plans. It's not so much about the coverage. It's not so much about the figures. It's about understanding the foundation for even considering any sort of insurance, any sort of savings, retirement plans, family indemnity plans. What is the negative impact that could befall you or those you love should something happen to your income? Yeah. All right. Now, the other thing that I encounter when dealing with persons, especially people who are now exploring financial planning, is something like this happens in their head. And I love this because there's a lot of important terms in this, but a lot of people don't know how to organize it. So when we talk about investment, you know, usually if you look at two of the bigger words, savings and investment, and people think it's the same when it really isn't. But retirement, your net worth, your nest egg, spending, your budget, all of these things come into play. What we try to do a lot of times is to help people put it in a particular order so that they understand how to approach it and realize that you don't have to sacrifice one for the other if it is you can afford it and you approach it in a more structured way. So one of the tools that we use is called the financial planning pyramid. I'm not sure if you all ever came across it, but this actually shows to a large extent how we suggest, we don't tell people, but how we suggest you approach creating your financial plan. And it's really broken down into two general areas. Now, like with any house, any building, you need a strong foundation. And if you look at the bottom of it, the main focus is protection. So yes, you may want to invest money. So many people, especially because of cost of living, because of responsibilities, they're so focused on making money that they may put themselves in a position where if things go wrong, they end up in a bigger hole than if they had done nothing. So our first step is to always try to protect what you already have. Bird in the hand with more than two in the bush, old people say. Yeah. So if you notice on the protection level, we talk about medical insurance, critical illness, disability, life insurance, debt reduction, paying off your loans, etc. That is for immediate protection against immediate risks. And we'll go back into the risks. But again, death, disability, critical illness, medical emergencies, things that could seriously negatively impact on your finances. Now, once that level is in place, we start looking to the future. And that's where regular savings come in. So we talk about having an emergency fund. Remember, one of the previous slides have, do you have 6 months of your monthly living expenses in savings? That is where things like emergency funds come into play. It doesn't have to be because of illness. It could be because you lost your job or you're put on furlough. Look at what happened to a lot of people, myself included, before this job, during COVID. So you need those emergency funds. Things for your children's education, retirement planning, home ownership, etc. Now, when we talk about regular savings, this is where not just, well, don't really count the bank so much because you don't get as much of an interest, but we talk about things like credit union, saving in the credit union, unit trust, certain types of plans we offer. The basis for regular saving is low risk for low returns, so that the value of your money will only ever go upwards. So the trajectory with regular savings is really a more risk-averse focus, where you don't want to take a lot of risk because you don't want, when you go into the fund, you end up being or having less than you expected. If you notice recently with unit trust, they removed that price protection on their income and growth. So That means that when you put in money into that fund, in the future, if you're withdrawing, if you're selling the shares and you're withdrawing, you are not guaranteed to at least get back what you invested. So that immediately put that fund in not a very high risk bracket, but in a higher risk bracket than it was before. For us, with insurance plans, with pension plans, with the credit unions and their savings plan, the focus is always to build. So it's a safer way of saving. Now, between protection and regular savings, this is where your income protection is. Now, you could say, if I have extra money, can I take a bit more risk? Growth and diversification, when you go into stocks, bonds, mutual funds, and so on, they do give you a higher return because it gives you a higher level of risk. And now we're tending from the risk averse, which is the protection and regular savings, more into the risk taking. We're going along the continuum. So growth and diversification, you're investing in these because if things don't really work out with those investments, you don't get the returns that you were expecting and so on, it doesn't mean that your financial pyramid is going to collapse because you had your emergency funds, you had your retirement plans in place and so on. So you can afford to take a bit more risk. Then we go into the much higher risk or more higher risk in types of investments, things like commodities, forex trading, real estate. People think that real estate is a fantastic investment, and it could be based on how you use it. Because one of the things that people don't realize with speculation is that you have to be able to lose money and it not negatively impact on your life. Because I'm sure we've gone, and just using real estate as an example, gone to many different locations throughout the country, and you've seen unfinished property developments. You've seen people who started building, whether it be a commercial property or a residential area, and it just came to a grinding halt. And it's speculation because there's so much outside of your control that will guarantee a positive return. Now, when we go to the top, which is wealth distribution, and we come into estate planning and succession planning, we're now saying this has nothing to do with you. This has everything to do with your family, your kids, your grandkids, and future generation. It is where you want to put things in place to create a strong financial platform so that future generations may not have to go through all the trials and tribulations that you would have gone through to reach this point. So when people talk about things like trusts, it's a valuable tool that people use to try and make sure that future generations don't spend out all the money that previous generations would have spent decades building. One of the more popular ones that I know is the waterfall method that was introduced. I can't remember if it was one of those American families that everything went into trust. So when they died, the life insurance benefits went into the trust, and the trust was being managed. So everything like their savings, properties, other assets, their businesses, everything was owned by the trust. And that was managed in a way to ensure that future generations will always have this financial buffer. Now, this is what we suggest, but it doesn't automatically mean that people will follow this hard and fast, because again, it boils down to your individual circumstances. Yeah. Another tool that we use now is the circle of life. And this is a time-based tool. The first one with the pyramid is about what you want to prioritize and how you go about prioritizing. This one is about when things can and should be done. So we go through different stages of our lives. First one, of course, is the youth stage. We're children, mommy and daddy seeing about everything for us. There's no salary. Into our 20s, hopefully, this is what we call the sector of first. Let's say between 20 and 30, thereabouts. First job, first car, home, you want to spend more money on tertiary education. Things like serious relationships, marriage and kids and so on come into play. Then we look at the sector of stability. That sector, usually anywhere between 30 to 60, is your highest income earning years. So you have the stable job. You could be like me and change jobs several times. asset building. So not just in terms of your house, but also in terms of investments that we spoke about in the pyramid. It could be additional properties, tertiary education for your kids, and putting more into retirement planning. And then, of course, you have your retirement, where it's now about really and truly maintaining a certain standard of living that you really and truly spent your whole life, your whole work life building towards. So having a dignified standard of living, travel, leisure hobbies, being able to cover medical expenses. Your children minding you is not an effective retirement plan because they all have their own lives to live. Now, one of the things that we use this circle of life for is to show that you start off your life without earning an income, and you will end your life, hopefully, if you live that long, to be in a situation where you're also no longer earning an income if you so choose. So what you really have is between 20 years to 60, well, now 65 years, to really not just build your financial status, but also put things in place to protect it during that period, and also put things in place to start building towards your future. Yeah. So one of the questions I like to ask people when it comes to circle of life is it's an American term, but we've all heard of middle age crisis. Anyone can tell me what is middle age in Trinidad and Tobago? What we would consider middle age? Any chat? Any random age? 40, 35? Any others? 35. Mm. Oh, 45. That's wishful thinking, Kelly. All right. So in Trinidad, middle age is considered 50. Ooh, that is very wishful thinking. In Trinidad, on average, middle age would be considered anywhere between 35 years to 37 years old. That is middle age for us locally. And this is why some people don't recognize that, and that's statistically speaking, because they believe they have time to do things. I have time for, especially retirement planning. I have time for to get involved with insurance. I have time to start saving. And what they do is they tend to go more when they start earning income into the spending phase. New job, first salary, all the things that I couldn't do before, I want to do now. And they basically delay planning. But waiting creates another problem. From a retirement and saving standpoint, the later you start, the less savings, the less interest you'll earn, and so on. So it doesn't really give you the kind of platform you'll need when you hit retirement. But also, when you wait for things like investing in insurance, you're putting yourself at immediate risk because death, disability, critical illness, medical issues, where's the money going to come from? And also, if you were to suffer these things, then the likelihood of you getting insurance diminishes. What a lot of people also don't know, and we hear it a lot, is diabetes and high blood pressure, hypertension is very prevalent in our country. And those two that people tend to undermine because they say it all the time, I have a little bit of it, and it's being controlled and so on. Control isn't cure. And those two account for about 70% of the deaths in Trinidad and Tobago. And it's no longer an old people thing. It is something where in my line of business, you see people suffering from these things at a young age, and it triggering major issues for people well below age 50. So the key to these things is really to understand how to go about financial planning and put things in place as soon as possible. Yeah, so we wish it was 50, but it really isn't. Not even in America, where they think it might be. All right. Now, a big concern for people is budgeting. And I would want to know how many people actually work with a budget and how do you prepare your budget? Is it a pen to paper thing? Do you do it in your head? Whatever is left over after all your living expenses, do you work with a budget? And how do you go about planning your budget? Anyone? And what is the biggest issue people would have with budgeting? Any ideas? And we're talking about a personal budget. You know, we tend to be able to work out budgets for work and stuff quite easily. But what about personal budgets? What are you saying? Discipline? Discipline or lack of discipline?
Well, lack
Would
of lack of
sorry.
discipline.
All right.
Indiscipline,
Now,
I should have put.
the question is then, what causes the lack of discipline with budgeting?
Time constraints.
Mhm.
That
So
is
you do your
one.
budgeting pen to paper kind of situation? Or
Not really. Not consistently,
Mhm.
but it's on the computer.
All right. So, and do you think it's a lack of discipline? Because I'm looking at Dovell. Dovell is also saying unexpected expenses, right?
Mm-hmm.
Do you think it's a lack of discipline or something may be wrong with the budget from the start?
Well, if you don't have a good template in the beginning, then
Mhm.
that can be a start. But if it is, for example, you don't have the discipline to complete the template
Mhm.
consistently, then you fall
Right.
off. And that
That
I
is
think
true.
is a common
Yeah.
challenge for persons.
And there is usually one foundation reason because whether you do it
Mm-hmm.
pen to paper, as Narissa and Dovell are saying in terms of Excel spreadsheet, tracking all your expenses is always going to be a headache, especially when you do impulse buying, you go in the mall and stuff like that, just buying lunch when you're not supposed to, things like that. But the main issue that people tend to have when doing their budget is they do what I call an aspirational budget.
Mm.
So when they're doing their, and this is where that discipline comes in, because an aspirational budget is basically what you want your budget to be.
Right.
But you start planning what you want your budget to be without first taking note of what your
Of what?
current budget is. And that jump is sometimes so great. It's kind of like saying, okay, you know what? I want to go to the gym and I'm going to start going to the gym 5 days for the week, twice a day. That's, you want to reach there, but if you accustomed just spending whole day behind a desk on your bed,
Yeah.
doing housework, seeing about the kids and so on, when are you going to get the time? So even when Dawal was talking about unexpected expenses,
Mm-hmm.
there are certain expenses that should be unexpected, right? And those are the expenses that nobody could plan for. But you see, going out to buy lunch 2 days for the week, that's not unexpected. What happens is people don't budget for it. So one of the tools that is very popular is what we call the 50-30-20 model, right? And what this does is it gives a basic template, all right? It was developed by Elizabeth Warren. It basically says 50% of your income goes to your necessities. So housing, transportation, insurance, groceries, healthcare, etc., utilities, and so on. Now, I break this up into two parts. That 50%, you have obligations and you have necessities. So your obligations are those that you know you pay every month, every 2 months, and you know exactly how much you're going to pay. So your mortgage, your car loan, your insurance premiums, your health premiums, things like that, your taxes, and so you know this
Yeah.
is how much is going to come out. The necessities are all those things you still pay every month, but they can vary from time to time. So things like your utilities, your
Utilities.
grocery, your gas
Mm-hmm.
bill, and so on.
Mm-hmm.
So that's the first thing that you take out. All right. The second thing, which is 30%, goes towards your wants. So this is how you want to spend your money because you're working hard for it. All right. So whether it be going out to eat, I'm a foodie, so I will look for new places to go and eat. Going out to line with friends, buying the newest spoon, whatever it is. You budget for it, right? So even when I go through a needs analysis with a client, we have miscellaneous. And what usually throws off everyone's budget is they don't plan a miscellaneous fund. They don't plan an entertainment fund. You know you. But they'll see a 50, 30, 20, and they want to, like Darvel said, he has his Excel spreadsheet, and he's going to divide it up exactly like this. But this is not realistic. And then 20% is towards your financial future, building up your savings, your retirement planning, paying off your loans quickly, etc. Because in most instances, the interest you get on your savings and investments will always be less than the interest you're paying on your loans.
Yeah.
So you want to, again, divide it accordingly. Now, this is just a template, like everyone likes to use. This is the aspirational. I've done budgets where it's 70, 20, 10 because of the person's income. Because if you earn 20,000 a month and your rent is 3,000 and someone is earning 8,000 and their rent is 3,000, it's totally different. And again, the mistake that a lot of people make is they're so focused on the aspirational that they move away from the realistic. And that is why when we do our interviews and so on, that is what we try to get to the realistic and then move on from there. And this is also, it'll give people an idea as to how much can I really put aside for that income protection, for that retirement and so on. Yeah.
Thank you. Yeah.
Welcome. Right. Now, again, when we go past the budget, we come back now to the financial risks. Remember, in your budgeting, you want to put aside money for your necessities, but you also want to put aside money in case you don't have the money to pay your necessities. And again, the 5 main financial risks we look at is the immediate death, disability, critical illness, medical issues, and so on, and medium to long term, old age, no savings, investments, stuff like that. But how do we go about doing it? So what do you think are some of the biggest mistakes people make when trying to choose insurance, and how do you think they can be avoided? So now we're focusing on, we know that we have risks, death, disability, critical illness, no retirement planning, no savings, and so on. We want to start getting into financial planning. We want to enhance our current financial planning. What are some of the ways we could go about doing that? So what do you think are some of the mistakes that people make when they're starting to consider insurance, or maybe when they're looking to expand on their current insurance portfolio? Anyone in the chat, or you want to speak? Any ideas? Anyone?
Yeah.
And this
Kailash,
is being realistic.
I think sometimes, there's so many products out there that we may not choose the one suited for us.
Okay.
So I think, making sure it's customizable to you and also reviewing it ever so often because circumstances change in your life. I still get to know about that middle ages, someone 25.
I apologize.
Circumstances change.
It's not my choice. That's statistically speaking. We blame the CSO.
Circumstances change, and sometimes we forget to ensure that all those things that we set up when we were young, change with our lifestyle and things that happen.
Absolutely.
So I think, yeah.
Yeah, and I like the fact that you talk about change, because that is what a lot of people don't do. They like to say, one of the most popular refrains I get is, well, I have insurance already. That's great. But the last time you spoke to your advisor was 15 years ago, and the man has since retired. So Paula is saying not enough coverage or fully understanding coverage. Yes, that is also true. But what do you think is the start point for us trying to avoid some of these mistakes? Because as Narissa said, there's a lot of information out there, a lot of providers, a lot of different products. And of course, if you look at an insurance contract, part of it is gibberish. You're not sure what it means. So where do you think is the most or the best possible start point when looking at insurance? Yeah, yes, it is. The purpose and why the insurance is being taken out. Yes, Kelly. So the start point is really you. And that's the mistake that most people make, especially now with so much information being presented online and so on. I have people asking me about plans that are not even available down here because they saw these plans advertised in the US. How come they could pay $10 a month for life insurance and we can't get that down here? There are a couple of things to consider. The first thing and the most important thing is you, your purpose, right? And your priorities. And here's the thing, that tends to set the ceiling, right? Really and truly. This is what I'm aiming for. That's the goal. But we just spoke about the other aspect, which is the budget. So the budget is basically the calming feature. Yes, you want $10 million in life insurance coverage, but your budget says, no, you have other things that you need to prioritize immediately. And this is where sometimes some is better than none. And what happens, as Narissa was saying, is you could start off with some, your financial situation has changed, but you're still comfortable with the sum, and you're not making adjustments down the road. Yeah. I usually liken financial planning, whatever tool you use, whether it be the insurance, pension plans, saving at the credit union, borrowing from the credit union, unit trust, whatever it is. Financial planning, most people look at it as a clear pathway when it's really a cross-country race, you know, like Amazing Race, where they have all these mountains and rivers and all these things. The best that you can do is plan for up to the next obstacle, which I call the next hill. So as Narissa was saying, things happen. But right now, you're this age, this is your budget, whether you're married or not, what is your health, do you have kids? This is your current situation. And based on your current situation, you're going to put things in place until another change has come about or something that may trigger a need for change. So you may be single, unmarried, no kids, working a good job, no mortgage, anything like that. So you have what we call selfish insurance. Everything is for you. But then the next hill is you get married. You now have a financial dependent, even though your spouse working for more money than you, it's still a financial dependent. It's a two-income household. So now we do a review. It doesn't mean that you have to make changes, but we want to make sure that it still serves your purpose or has your purpose changed. Then the next hill could be children. Or even before children, you change jobs or you've paid off your loans. So what happens is if there's any major personal or financial changes in your life, you should reach out to your advisor to do a review. Because if you're like me, I'm not going to be all up in your business. It's a partnership. I reach out to you when I can, but if there's something going on in your life, you reach out to me and we have a chat about it. So, like, for example, recently, a client of mine, he, young, unmarried, no kids, nothing like that. So all the insurance was for him. He took out critical illness, he took out an endowment plan, he took out a pension plan, everything for him. And then he decided to go buy a car. And with this car loan now, he went way over what he should have gone in terms of taking out that loan. So now he's stuck in a position where he may have to make a choice of sacrificing the insurance and all the premiums he would have paid before in order to pay for this vehicle. When he pays off for the vehicle in 5 years, he's now 5 years older, the premiums will have adjusted for the same coverage. And this is where, again, financial planning and coordinating all your financial tools becomes important. So what we do to try and address that is what we call, basically the financial planning cycle, which is this. So step one, as we said, is to find out about you. Who are you? What are your priorities? What is your financial situation, etc. That is what the needs analysis is. Step two is to develop your financial goals. And as Narissa was saying, these can change over time. Actually, they should change over time. If at 21, your goal is the same as when you're 35, then something is not clicking correctly. So your financial goals, is it about protecting your income? Is it about protecting your family? Is it about you wanting things for yourself? Is it about retirement planning? How many of those goals can we really address? Step 3 is to identify the alternative courses of action. And that is where the different plans and products come into play. As you all said, there's so many products on the market. So different types of life insurance policies, we'll get into that. Critical illness policies, health plans, savings at the credit union, savings in unit trust, savings on insurance plans. We look at all the alternatives and then we evaluate those alternatives based on their risks and the considerations to what extent will they fit the needs and the priorities of the client. Once it is we've done that evaluation, we then create and implement your financial action plan. A lot of people believe that a life insurance policy is a financial plan. It really isn't. It's a financial product. Just like an account with a credit union is a financial product. Critical illness, health plans, a pension plan, all financial products. What we seek to do is get all the information so we could piece together a financial plan from all these different products. And that is why a financial plan is more akin to a puzzle where different pieces have different uses. And individually, it may not make a lot of sense, but when you put it together correctly, you get a clear picture of what your financial benefits are immediately, financial protection maybe immediately, and what you can expect in the future. And then step 6, which is what a lot of people don't do, is you review and you revise your financial plan periodically. Like I said, it doesn't have to be every year or every 2 years. Some of my clients don't like that, but I tell them, again, if there are any personal or financial changes in your life, reach out and let's have a discussion. The downside of not doing those reviews is, again, what happens to a lot of people where they took out life insurance when they were 25 because 65 was like 600 years away. And now they're 62 years old and realizing that the life insurance coverage is going to come to an end at age 65. And this is where now that buyer's remorse comes into play. Or it's a ripoff, or it didn't make sense, nobody told them that, etc., etc. But it's just because people get comfortable and they like to say, I have it, and they don't see the need for making changes. And I usually tell my clients, I would have surrendered more policies in my life than most people would have taken out in their lives. But you can't hold on to the past just because you've spent money there. You have to focus on where you are now and where you're going in the future, because that is where the necessity for proper financial planning comes into play, now and in the future. Yeah. So to do that, once we go through this, I did a little bit of a snapshot of the different options available. Yeah. You all have any questions or anything before I move on? Or you're all okay, comfortable? Yeah? Okay. So coming back to some of the questions that were posted in the chat in terms of having so many options, I just put together a few of those options. The first one, of course, is, or the first question is, how do you determine the right type of coverage for your circumstances and what factors should be considered or prioritized? So Kelly said your purpose. Now, what is the purpose? Is it to protect you? Is it to protect your family? Is it to protect against a mortgage? Is it to save towards your future, whether it be midterm or whether it be long-term in terms of retirement? Besides your purpose and your budget, right? Because those are the two cornerstones. Are there any other factors we should consider when looking at particular types of coverage or just any type of financial product in general? I took away the big two, purpose and budget. Any ideas? Anything else to consider? Or you think those are enough to create a framework? No? We're good? All right, so let's go into the options and stuff then. All right, so Term life insurance is basically very popular because it is the cheapest form of insurance that there is. It's what we call pure insurance. This is actually where all life insurance started way back when, centuries ago. Life insurance for a specific period of time. If you die during that period, we pay out the money. If you live to the end of the period, coverage simply comes to an end. And that is why it tends to be favored for things like mortgages, or when you have young kids and so on, and you need a lot of insurance cheaply. All right. We come to whole life insurance now. So this is life insurance till age 100. It does accumulate a cash surrender value. So if down the road you choose to discontinue it or you need funds even before that, you can borrow from the cash value. Premiums are largely consistent. But because now there's this cash value element or this investment element included in the premium, it does cost a bit more than the term life. But again, it gives you this alternative source of financing through loans. One of the things that people use whole life for, remember when we spoke in the pyramid about estate planning, creating generational wealth and so on? Whole life insurance is the plan that is most used for that because it's a when you die type of insurance, whereas term life is a if you die within a certain time frame type of insurance. So this guarantees that whenever you die, money will be left behind for your beneficiaries that could help them elevate their financial status. It could help them speed up certain parts of their financial life. So the money you leave behind could help pay off your kids' mortgage. It could help pay for your grandkids' education. So this is money that your children don't have to save up or put out. Then we have the family indemnity plan, which is offered through the credit unions and so on. It's a fantastic option when it is you're looking for cheaper coverage for a family. Most insurance companies don't offer family indemnity plans, mainly because our coverage extends usually to far higher levels than family indemnity plans would offer, because I think the cutoff might be maybe 100,000, maybe more. Whereas with an individual life insurance plan, you could get millions on one life insurance policy. So the underwriting and the assessment and everything is usually a bit more stringent. But I think it is a fantastic plan. I've recommended this to many of the persons I've spoken to because they're concerned about not just themselves, but their spouse and their parents and stuff like that. And this is something that is less stringent in the underwriting, and the cost is usually something that works for people. Then we have endowments. Endowments are limited term life insurance policies, like a term life, but now the sum assured is a maturity benefit. So this is a form of life insurance and guaranteed savings. So how it works is, let's say you take an endowment for 500,000 up to age 65 because you want to use it as a retirement benefit. From now till age 65, you have 500,000 life insurance coverage. If you die, we pay out the money to your beneficiary. But the plan has a cash value that builds up to reach 500,000 by the time you reach age 65. So once you live to age 65, you get that 500,000 as a guaranteed tax-free lump sum, and the life insurance benefit comes to an end. Now, because we're paying out this 500,000 within a limited time frame, either in life or in death, the premiums for this tend to be a bit higher per thousand of coverage than your whole life and your term life, right? But this is a plan that a lot of people use for their kids' education. They use it to pay off their mortgages faster. Some people use it as a retirement benefit because they already have their work pension, they have their personal pension, hopefully they get NIS. So monthly retirement benefits are already there. They like to get a lump sum of money that they could use for some other form of investment, for another type of income earning activity, put up apartments, buy a maxi to work for them, etc. Then we have the critical illness coverage, which I spoke about before. Unlike a health plan, critical illness coverage focuses on specific major medical conditions. So for example, we have 3 versions: the triple protector for the big 3, heart attack, stroke, cancer, our max protector that covers 6, and then our life protector that covers 21. So of course, the coverage would vary, the premiums would vary, the underwriting would vary. but they're all focused on paying out this lump sum. It's a one-time claim within a certain period of time that we pay out this lump sum, and you could use that money for whatever you want, including medical bills. And then, of course, we have the pensions and annuities, which is focused on retirement. The benefit of the pensions is, to a large extent, you determine how much you're going to contribute, what retirement age you want. You could put in additional lump sums to build up the retirement fund if you want. And it is a monthly income guaranteed for life. Now, one of the things that a lot of people don't use effectively for the annuity is really and truly the tax break. Anyone knows how to go about using the tax break for pension plans, and only tax registered pension plans? So you have registered and unregistered, but there are a lot of benefits to actually having a tax registered annuity. Anyone ever used it for the tax breaks?
Yeah, Kailash, I've used it, and you can get it approved by the Board of Inland Revenue
Yeah.
upfront through your TD1, or you can wait and claim it when you file your tax return.
Yes. And yes, you could get claim up to 60,000, as Rashmi Prasad is saying there, up to 60,000 on your tax return. The benefit is really and truly not just that. All right, it gives you the tax breaks, but if we go back to one of the earlier issues with the budgeting and discipline, how do you use it? Now, a lot of people like the tax breaks on their TD1 because you pay less taxes during the year. So your disposable income is more. What do you do with that disposable income? Do you not spend it? So this is where discipline comes in. That money is really meant for your retirement. So what sometimes I recommend for persons is, if you really want to be disciplined about using it for retirement, don't claim it on your TD1. Claim it on your tax return. So when you get this tax refund, this lump sum, you can now redeposit it the following year, whenever you get it, onto the TSAP, and then claim for a higher tax break. And then what you're doing now is compounding the tax breaks that you're going to get, and therefore build up that pension fund to give you a larger pension at retirement. So it is one of the ways of not just utilizing the compounding interest, the traditional compounding interest on deposits you get with an annuity. By using this, you're compounding not just the interest on deposits, because you're making an additional deposit, which we will apply interest to, but you're now giving yourself a bigger claim for the following year. So if, let's say, you paid 6,000 in premiums by the end of the year, and you get a tax break, we'll use simple figures of $1,000, a tax refund of $1,000 for 2026. In 2027, you deposit that $1,000, right? Not only when we're applying interest, would we now apply interest on the 7,000 deposited in 2027. When you're doing your tax return for 2027, you're now claiming on $7,000. And then you get let's say, a $1,200 refund. So in 2028, you're now depositing the $1,200, and that is how you keep building the fund. Now, that's one benefit. The other benefit is that we don't know where life can take us. And if you're like me, you've changed jobs quite a number of times because you don't know where life takes you. The BIR is now allowing persons to roll over their work pensions into their own personal tax-secured annuities. So before, what used to happen is, if you had a work pension and it was a group pension, you either, if you change jobs, leave your pension right there, and then whenever you retire, hopefully the company is still around, and you could get your pension from them whenever you retire, or you break the pension, and then it's down to how much you get. A lot of times, what used to happen is the employer would give the employee who is leaving their portion plus whatever interest would have accrued on the employee's contribution. So the employee doesn't always get the full value. So the employer basically keeps their part and the interest that was earned. With this new benefit, sometimes having this tax savings annuity separate and apart from your work pension, it's not just planning for your long-term future in terms of your pension and retirement, but also planning for a shorter-term future just in case you change jobs. And you can take your work pension from your current job, roll it over into this personal pension, and then move on. So that is one of the things that I look at with recommending to my clients. Yeah. I saw Luke ask a question, what's the cost once you qualify? And the cost, assuming you're talking about the insurance plans, Luke, is that it? Could you just say in the chat if it was the life insurance critical illness you were talking about? I'm not sure. The thing with, all right, so with the life insurance, well, it varies. Life insurance is very customizable, so there isn't a set cost. You see, unlike things like a car, a house, or anything you find in a grocery where it's the same price for everyone. As we established before, different plans for different purposes, different budgets, and so on. So to a large extent, you can determine the cost that you're going to pay for your premium. But sometimes if you want to stay within a certain budget, it means that the coverage you're going to get may need to be reduced. So there's always that trade-off, again, between the coverage you want to get and the premium you want to pay. So when we do our needs analysis, it gives us that framework, your priorities, your budget, which plans we're going to look at, and we try and customize it to suit you. So there isn't a set premium for any plan. Now, if you look at family indemnity plans, as far as I know, there are set premiums for set levels of coverage, right? But again, the coverage on those tend to be within certain limits, whereas with a life insurance policy, the cost for $1 million term life policy would be cheaper than $1 million endowment or $1 million whole life. So it really boils down to a number of factors. So we're going back. Yeah. All right. So the question now is, we know we have different options, and we're focusing again on the insurance part of it, and then we'll focus on the pension part of it. So how do you determine what is the right amount of coverage for you or your family, or for the insurance policy, whether it be life insurance, critical illness? How do you determine what is the right amount of coverage that you will need? Anyone has any ideas? Any clues? Anyone here have insurance that they have insurance and they don't know if they have enough insurance, if they're underinsured, if they're overinsured? You don't have to tell me how much coverage you have, but this is a bit of self-examination as well. If you have coverage, do you actually have the right amount of coverage, or did you just take a figure that sounds nice? Yeah, all right, Luke. I think they put a link to my client information page in the chat and so on. So you could always message me directly and we'll sort that out. So you think you have enough, Mr. Rodriguez? I don't want to know how much is enough, but why do you think you have enough? Have you been told that you have enough, or you think for yourself that you have enough? I'll put you on the spot a little bit here. Yeah. Okay. So here's a little exercise for you. Remember before I said we look at living expenses with your budget and so on? Okay. Do this little exercise. Look at your sum assured for your life insurance or your critical illness, whatever it is. And we're not looking at your salary, we're looking at your living expenses. So your mortgage, loans, grocery bills, kids, all the bills you pay. Divide your sum assured of your insurance by that figure of your living expenses, and see how long it lasts. So you can do that for yourself and then see, okay, do I really have enough? Yeah, so there are certain trends or certain rules of thumb that we use when it comes to insurance coverage. A basic rule of thumb as a start point is that persons should have anywhere between 5, 10, 15 years of their annual income in terms of life insurance. Now, just like the 50, 30, 20 rule for budgeting, it's just a start point. For some people, that might be over-insuring themselves, right? That's a rule of thumb. We have other methods. One method I just gave to Mr. Rodriguez, that's about living expenses. So what you would want to have is about 5 years or 10 years of living expenses as your insurance coverage. Yeah. Another person would have what we call human capital, which is now not about your living expenses, but your income. So if you earn 10,000 a month, right, that's 120,000 for the year, you should have at least 1.2 million in life insurance coverage. So that's another strategy that is used. Now, people will say, well, why and how come? Again, it's all customizable. But usually we put that time frame because if anything were to happen, it gives his family that time at the same standard of living, his or her family at the same standard of living, for them to get their other finances in some sort of order. Another very strange method that we use is called the last child method. You have however many kids, but they are all financial dependents on you and your income until they reach an age where they become self-sufficient. So by using the last child method, we're saying if my last child is 3 years old, they would be old enough out of university or whatever it is to start working, let's say at age 20, 21, 22, 23, let's say 23. So what that means is you really need 20 years of your income as income protection in case something happens to you today, tomorrow. Remember, death, disability, critical illness are all immediate risks. You need about 20 years of your income because this last child, plus all the others, the other two who are older, will be dependent on your income until they reach an age where they're self-sufficient. That's the goal. What usually caps us is the budget. So you might need $2 million in life insurance coverage, but your budget says you can get 750,000. It makes sense to invest in that 750,000. So you see how many things we consider before we even start talking about the different plans that are available. Yeah, so you all can let me know if you think that makes sense to you, or if you think it's a bit weird, or if you used any different method when speaking to your advisor about how much insurance coverage you needed. Yeah. So we go back. All right. So the next question is, as Mr. Rodriguez says, he has all. All right. So if you were to describe your current financial plan as an animal, what type of animal would it be? Would it be a sloth? Because you're kind of deciding, you kind of have some, but you're still thinking. I've had clients who've been thinking for 3 years and have done nothing already yet. All right. It's a squirrel with a few nuts hidden. So you have stuff, but is it really part of a comprehensive plan? Or is it that you just pick and choose what you thought would be best suited for you? Is it a great white shark where you have nothing to worry about, like Mr. Rodriguez, hopefully? Or is it a dodo bird because it's non-existent? Which, unfortunately, too many people locally have that particular issue where it's just totally non-existent. So what do you all think? How would you class your financial planning or your approach to financial planning thus far? Sloth, squirrel, shark, or dodo bird? Well, I don't think anyone here would be a dodo bird, so we're taking that off altogether. But what do you think? Yeah. All right. And well, basically, folks, that is the last food for thought that I had for this presentation. The last thing is really just a bit of contact information. But as Darrell did, he put my Google form into the chat. So anyone who's interested in having a more individualized conversation, you could always click on the link, fill out the form, I'll get in touch with you. And it's really, again, just to better understand you, if you have current coverage, what gaps may be there, and then see if there's anything we could do to assist. But right now, it's really up to you all. If you all have any questions or any feedback, anything that you would like to put forward in the group, and let me know.
Thank you, Kailash. Paula is also joining us. She is a member of the Education Committee as well, too. Thanks, Paula.
No problem, Marissa. Thanks, Kailash. I haven't seen any questions, well, as yet in the chat. But I can probably start off, Kailash, in terms of you have spoken a lot, and thanks for giving us a lot of food for thought, including this whole income protection, etc. But for someone starting off, and I know you mentioned that 35 to 37 is middle age. I mean, that was so surprising. I think that shocked most of us. But what type of insurance do you think they should prioritize first?
Well, you see, it still boils down to what they want for themselves and their futures.
Okay.
All right. So,
Right.
for example, a young person, and this is real examples. He's really about himself. So he's 24 years working for a good salary. So he chose the endowment plan because his focus is, yes, he needs life insurance, but it's really selfish insurance because he's not married, no kids, nothing like that. So the endowment is a good start-off plan. Critical illness is a good start-off plan. Health insurance is good start-off plan, and a pension. All right.
Right.
For a couple of reasons, they're all, with the exception of the pension plan, they're all health-based. So you don't want to wait, not just age-based, but health-based. So you don't want to wait until a health issue arises and then you now start looking for it, which tends to happen. Because you start early, it's cheaper. Yeah.
Right.
But on the flip side, I had another young guy who said he have like his whole life planned out. Marriage, kids. Now he's still single, you know, hoping to get married next year or something like that. He's 26. So he chose to bypass the endowment altogether and take out a $2 million whole life insurance because his focus is getting married, have kids, going to take a mortgage, whole life insurance. Let me take it now because it's going to be cheaper. So it always boils down to an individual circumstance. But startup plans, generally speaking, endowments, critical illness, health plans, pension plans. And then you could always add later on, depending on your needs.
Yeah, I guess depending on the person's circumstance, they would choose one first and then kind of build as they go along. Young persons don't tend to think about becoming ill at that point in time, but maybe when they get to middle age or 40s, then they start realizing that a lot of health challenges come.
And unfortunately, sometimes by that time, it's too late to get the coverage. So, but it doesn't exclude people older from getting the endowments or the critical illness and so on. It's just a matter of what options and cost comes into play.
Okay.
So for example, you could apply for an endowment plan up to age 55 if you want.
Oh.
You know, so of course the options would be a bit limited. It'll be a bit more expensive, but it doesn't write you off completely from getting a lump sum.
Okay.
Yeah.
All right. Narissa, you wanted to ask
just one
something?
Thanks, Paula. One question, Kailash. In terms of affordability, how can individuals balance affordability with adequate protection? Because there's this balance now, right?
Yeah.
Do I have enough money to meet the needs I have? And in my mind, you better have something than have nothing, right?
Yeah.
So how do you balance that?
Well, this is where, again, working with them and in the needs analysis and the budget comes into play, right? And it's always going to be down to an individual. Unfortunately, there have been circumstances where I told people that you cannot afford. insurance, because we don't want you to get into a plan and then 6 months down the road, you're unable to maintain it. That's how you lose money with insurance, because you're not going to get a refund, right? There have been a lot of instances where I've referred them to the indemnity plans because it serves their purpose. So the balance is always going to be tricky, because sometimes to get the coverage that you really need, you have to make sacrifices elsewhere. And it boils down to the individual if they're willing and able to make those sacrifices. If you're able to make it, then it comes down now to choice. And again, remember, if you go back to the pyramid, a lot of people may not want to invest too much in the insurance and the income protection because they want to have a certain amount of money to invest to make money. Yeah. And what we try to do is kind of balance out all their priorities. We make recommendations, but at the end of the day, it boils down to the choice of the client.
Right.
But balance for one person would mean different from balance. So for example, like with Mr. Rodriguez, he says he has enough and he has everything. So he might be quite unbalanced from a budgetary standpoint, right? But quite well insured and protected financially. You understand? Because someone else could look at what he has and say, now you're spending too much money on those things. And they would choose to take less coverage and spend more money in terms of speculation, in terms of other types of investments in land and all these kinds of things.
Right. Thank you so much, Kailash. This was, oh, go ahead, Paula.
No, I just wanted to ask Kailash, based on your experience, why do you think persons hesitate or struggle to take action when it comes to financial planning?
There are a number of reasons. The first one is usually mental, all right? In that they will see things happening to everyone around them, but God is a Trinity and it's never going to happen to them. So that's the first hurdle, all right? Getting them to realize that it is something that you should consider. You don't have to buy it, but be open to it. The second thing is bad experiences of others, right? Now, one of the things that, because the insurance industry is criticized quite often. So what they do is they look and they listen to the experience of others and they internalize that. And that prevents them from getting more information. Now, what I usually like to tell people, it could be for a number of reasons. Like was said earlier, they didn't understand what they took in the first place. It was misrepresented, but everything boils back down to whatever is in the contract. And most people don't read their insurance contract, so they don't even know what's in it, when the coverage is going to end, if there are any exceptions and exclusions. So when it comes time for a claim and there's an exception or exclusion, they're quarreling, but this is what you signed to. You understand? This is what you agreed on. So the complexity, we try to break down the complexity as much as possible, but sometimes people, they let that become a burden for them. The other thing I say is a lot of people who have negative experiences don't ever admit to their part in those negative experiences, because they will say the insurance company didn't pay out, but they're not going to say that they lied on the application.
All right.
You understand? So we have those personal issues to get over. Another thing, of course, is so much information. So you have that overstimulus, and sometimes it desensitizes people. So instead of them seeing a lot of information and thinking it's something they should do or look into, it ends up being, well, it has so many things out there. I'm sure when I'm ready, I'm going to get one that serves me, and they're going to use that as a delay tactic as well. And then sometimes it's just a budgetary thing that they think they don't have enough money. And because they think they don't have enough money, they don't reach out to see if there are actual options. But I've sold policies for as low as $200 a month.
Okay. I know sometimes with policies, it's so voluminous that, you know, persons really depend on the agents to sort of like guide them, especially if they're younger. They know, you know, maybe family told them, well, look, you need to have insurance. So an agent approaches them, they take out the insurance, and then after explaining, the agent will say, okay, sign here. Nobody's going to really read through all of that.
Right.
It's a lot, to be honest.
And honestly, that is something that as an industry we learn from.
Mhm.
because no one is going to put their head on a block and say all agents did the correct thing.
Yeah.
But we put things in place. So a couple of things, like we have policy delivery receipts when people collect their contract. We are supposed to actually sit and go through the contract with them before they
Mhm.
sign as receiving, make sure they understand the key parts. And
Yeah.
also there's a 10-day free look letter that our clients
Okay.
get. So that when you get your policy contract, you have 10 days from the date of receiving that contract to go and talk to whoever you want. So your parents, your lawyer, your doctor, whoever you want to talk to. And if it is within that 10 days, you decide that it's not for you, you could simply sign the return letter and we reverse
Okay.
everything. So we try to take as many steps as possible to make sure that the people are really comfortable and they understand the coverage that they have.
All right, thank you. I'll pass you back to Narissa. I think I'm not seeing any other questions in the chat. I don't know if anyone has questions to come off mute and ask, but this has been very insightful, Kailash. A lot of food for thought, as your last slide showed. So hopefully persons on the call, if they have not yet seriously thought about, financial planning, then it would be a good place to start by contacting you.
I appreciate the opportunity to
Yeah.
speak with you all. It's been really nice. I appreciated the questions, everything.
Thank you, Kailash. And a gentle reminder to our members that our 73rd AGM is upcoming and will be held on Thursday, the 9th of April, 5:30 p.m. at the Center of Excellence. And we look forward to seeing all members. We thank you for joining this evening's session, and we hope that this session was very informative and helpful. Wish everyone a good night, and thank you again,
Okay.
Kailash.
Welcome. Have a good night, everyone.
Bye. Thank
Bye.
you.
Bye.
Thanks, Narissa.
Thanks, Paula.